Hello! Welcome to the Birkenroad Reports video presentation for Hornbeck Offshore Services. I will guide you through this exposition as I explain the fundamental aspects of Hornbeck's business and our future projections. My fearless Birkenroad team is comprised of Danny Goldbaum, Spencer Kaufman, Garrett Langfeld, and myself, Sam Fema. We are all proud A.B. Freeman School of Business students who have been determined to fully understand Hornbeck and try to accurately predict where its stock price will be in 1 year. We have decided to give Hornbeck a market performed stock rating with a 12-month target price of $14.63. Hornbeck Offshore Services provides marine transportation, subsea installation, and accommodation support services to exploration and production, oilfield service, offshore construction, and U.S. military customers. Founded in 1997, Hornbeck is led by its founder and CEO Todd Hornbeck in Covington, Louisiana. The company owns and operates many offshore supply vessels, OSVs, and multi-purpose support vessels, MPSVs. Simply put, Hornbeck operates boats that transport supplies, cargo, and people to and from offshore oil rigs. Hornbeck has a fleet of 65 vessels. 38 are active OSVs, 6 are active MPSVs, and 21 are stacked OSVs. Stacked vessels are inactive and cost significantly less to maintain than active vessels. We will touch more on stacked vessels later in this presentation. Hornbeck mainly operates in the Gulf of Mexico, but also has operations in Brazil and Mexico as well. 30 of the 44 active vessels are in the Gulf of Mexico, while the other 14 are in foreign waters. Hornbeck's fleet is among the youngest in the industry, with an average vessel age of 7 years, as opposed to the industry's 10-year average. Now I want to take you in depth on our investment thesis. With the continued downturn in oil prices, the entire oil and gas industry, let alone Hornbeck Offshore, has a bleak short-term future outlook. The low commodity price environment has reduced offshore drilling activity, driving down demand for Hornbeck's vessels. However, Hornbeck has a healthy balance sheet and senior notes with favorable interest rates and dates to maturity. The excess of cash and attractive debt holdings will certainly help Hornbeck survive the storm. Throughout the energy market depression, Hornbeck has stuck to its guns and maintained its short-term contract strategy. While this strategy commands higher day rates, it can lead to greater volatility. The near completion of the company's fifth new build program will decrease future capex and increase future free cash flow. And finally, changes in Brazil and Mexico may lead to new opportunities. The price of oil will have a significant impact on Hornbeck's future outlook. The low commodity price environment has negatively affected the entire oil and gas industry, and Hornbeck is not immune. This current situation has caused a major reduction in expensive offshore drilling projects, significantly decreasing the demand for all offshore vessels and Hornbeck's fleet. As a result, Hornbeck's utilization rate has taken a hit. As you can see, Hornbeck's utilization rate has been decreasing ever since oil prices have been. The company tries to combat this utilization rate decrease by stacking vessels and lowering the supply of boats in the market. Additionally, Hornbeck has had to reduce its day rates in order to accommodate their customers. Thus, lower oil prices have led to smaller revenue stream for Hornbeck. We do not predict oil prices to rebound in 2016, so our projections do not predict an increase in Hornbeck's revenue. However, Hornbeck Offshore has a healthy balance sheet that will help weather the storm. With over $300 million in cash and cash equivalents, the company is in a strong financial position to settle its interest payments and pay any extraordinary expenses. Hornbeck will be able to survive this downturn even if it does not turn a profit in future quarters. Advantageous debt financing Hornbeck received in 2013 helps its case. The company has just over $1 billion of senior notes, but none are due until 2019 at the earliest. Additionally, the weighted average cost of debt on these notes is a mere 4.48%. And if disaster strikes, HORNBECK has a $300 million revolving credit facility that it has never drawn on. But their strategy throughout this downturn has raised some eyebrows. HORNBECK has always targeted short-term contracts in the spot market. While the company does engage in a few long-term contracts to help hedge against oil prices, HORNBECK prefers shorter contracts because it allows for higher day rates. HORNBECK targets customers that are in immediate need of an extra vessel. For instance, HORNBECK thrives when oil rigs need servicing after a hurricane in the Gulf. Additionally, HORNBECK believes its boats are younger, safer, and more technologically capable than its peers. Thus, HORNBECK's fleet should demand a higher day rate. HORNBECK is not willing to take a lower day rate. As you can see, HORNBECK's day rates have remained relatively stable, but is heading for a drop. There is immense downward pricing pressure on HORNBECK, and it will not be able to maintain these rates through the entire low price environment. As a result, the company has stacked 21 vessels to date and will continue to do so in order to maintain their high day rates. As one top executive said, HORNBECK would rather have a boat sit in the harbor than be active at a lower day rate than what the company demands. Instead of locking a day rate over a long period of time, HORNBECK will continue to experience volatility with day rates in the spot market. HORNBECK is nearing the completion of its 5th new build program. HORNBECK has spent approximately $1.17 billion in capital expenditures on the project in order to keep its fleet more technologically advanced than its competitors' boats. The program will be complete over the next year, and the company has only $95 million left to be incurred. With many new boats in its fleet and a bleak outlook for the offshore drilling industry, HORNBECK will not spend much money on growth capital expenditures once the program is complete. HORNBECK also recently completed the sale of its 4th vessel to the U.S. Navy, adding $38 million to its balance sheet and reducing its maintenance capex spending. While HORNBECK's revenue will clearly suffer from oil prices, its future free cash flow will not be hindered by capital expenditure spending. Changing conditions in Mexico and Brazil will also influence HORNBECK's future outlook. Before 2013, Pemex, Mexico's state-owned energy company, was HORNBECK's sole customer in the industry. In 2013, Mexico's Congress voted to end the company's monopoly over Mexican oil. New competitors will enter the industry, and increased competition among these E&P companies will likely drive rates up and raise HORNBECK's revenues. The situation in Brazil is not as optimistic. The Brazilian nationalized oil company, Petrobras, has been involved in scandals and faced charges of corruption, and the company will not renew its contracts with HORNBECK. The company will send 2 vessels from Brazil to the Gulf of Mexico and leave 2 vessels in Brazil in case of new opportunities. Furthermore, HORNBECK does not know if Petrobras can pay the full amount specified in their contracts. However, HORNBECK's future cash flows will be more predictable as it moves a greater percentage of its activity to more politically stable regions such as the U.S. Gulf of Mexico. And now on to our valuation. HORNBECK Offshore's stock has not been performing well ever since oil prices took a tumble. The stock price was above $45 in the summer of 2014, but today it is at $12.44. We are projecting HORNBECK's stock market to market perform the rest of the year. We project the stock to be at $14.63, 1 cent from today. We use the relative multiples method to project the price. We took HORNBECK's publicly traded peer companies and found certain metrics by which they are valued. We averaged each of these companies' multiples and applied them to our 1-year HORNBECK projections. The 5 multiples we used were price to earnings, price to book value, enterprise value to earnings before interest and taxes, enterprise value sales, and price to cash flow per share. We equally weighted all 5 multiples and found a target price of $14.63. We really appreciate you watching this video and hearing about our investment thesis